Hey there, I am coming to you guys today. We are going to be talking about something that is amazing. It's a once in a lifetime thing that happens, and it is an assumable mortgage. So if you're a seller and you have this great low interest rate, maybe 3.5%, 4%, somewhere in that range, and you're like, listen, I got to sell my house and the values have dropped and I might be even upside down or really close. I'm going to show you how you can get top dollar for your house. Pay attention right after this. Hey, I'm Gary Meek with the Living in Sacramento team, and you have turned on YouTube today. You are checking us out. You are checking out our channel, finding out about assumable mortgages. Now, we are specifically talking to the sellers today. I did a different video that is about the buyer side and all the benefits to them. So that is a great thing. You guys should check it out on our channel. But for today, we're talking about the sellers. So you as a seller have decided, hey, I got something happening in my life, big life change. We're downsizing, upsizing. We got to move out of the state. Somebody lost a job. Hopefully no one got sick, anything like that happened. But for you sellers that have interest rates in the 2, 3, 4%, and you are a VA or an FHA loan, your loan is assumable. Now, I'm not sure if you guys knew that, but it is. So let's talk about some of the details. First and foremost, it's only FHA and VA. So if you have an FHA loan, a buyer can assume that loan that you have with very little cost to them because they don't have to go through the whole mortgage process. So the cost to assume the loan is only like $1,500. Now, it does take a little bit longer, probably going to be in the 60-day range for the person to assume the loan, which, hey, that's just one of the things that we got to deal with. But here's the thing. You are selling your property in time right now where the market's shifting, interest rates are up, not a lot of buyers out there, and some of the values have actually come down. Possibly you bought your house at the end of 21, early 22, you got the great rate, but you paid absolute top dollar for your house. And hey, maybe it's kind of upside down right now or really, really close. So what if we could help you sell your property in today's market, but we're not going to sell it based on the value really where it is today. We're going to sell it based on the payment. So we're going to jump in and show you guys the differences in payment and how we can help you as a seller. All right, so we're going to jump in here and we're going to talk about our interest rates and we're going to talk about our payments. You'll see that I have a mortgagecalculator.org. That is a website I go to, I use all the time. If you want to check this website out and punch in your own scenario, you can. But let's check this out. So the very first thing, we have a buyer that's looking to spend $500,000. Happens to be that you paid $500,000 for your house. Maybe it's only worth $480 right now, but nonetheless, we're talking about a $500,000 valuation. So if a current buyer goes and gets qualified for $500,000 and they have a down payment of about 20 grand, that's FHA, 3.5% down and some closing costs, end up with about a 480 loan and a 7% interest rate. You'll see I have property taxes at $5,000, PMI, HOA, homeowners insurance, and you'll see that it's FHA. I calculate this here and you'll see that a buyer in today's economy is going to spend $3,900 in order to buy your house, right? That is a big number. And my guess is you're not paying anything near that. So here's probably what you're paying. So we're going to say that you have a 4% loan. You'll see that I have the information here is exactly the same. $500,000 house at a 4% interest rate. Your payment's probably at the $3,000 range. So that's roughly a $900 savings to the new buyer. So if I could get a buyer that's interested in your house at $500,000 and they're going to be able to pay $3,000 a month rather than $3,900, remember the scenario, 7% is $3,900 and your rate at 4% and maybe even better is at $3,000. So what if I could go to that buyer and say, here's the deal. It's $500,000 and you can buy their interest rate from them for 4%. So they're like, man, my $3,000, that's amazing. I'm saving $900 a month. Now we can go to them and say, listen, because the seller's willing to sell you this interest rate at this amazing rate, we need to get them some additional benefit. So the seller has to have some benefit as well, right? So we're going to say, listen, instead of $20,000 down, I actually need you guys to put $50,000 down. Now that can easily be done. And they may have grandma and grandpa can help out. They might have money in 401k. Some buyers just have that money because they've been saving and saving and saving. And so now they have the extra money. They can put a little extra in your pocket and pay the commissions. There's lots of different ways to structure the deal. But what about this? What even if I could get that buyer to assume your loan, and then we did what's called a seller carry for the $50,000? They don't have the $50,000. They only have the $20,000. But we say, here's the deal. We're going to give you a $50,000 second owner carry. That means that buyer is going to pay you a dollar figure for the next 2, 3, 5, 10 years. All right. So here's our secondary financing. This is what we talked about, was the buyers coming with some additional funds. If they don't have it up front, they may have it on the backside. What we could do is we could let them buy your interest rate at 4%. And they're going to come in with that $20,000 down, pay the closing costs, commissions, all the stuff. And then we say, listen, you're saving $900 a month. That is an amazing savings to you as a new buyer, but we just can't give you that rate. We got to sell it to you. You got to pay us a little extra because we got that amazing rate. We got to make this equally, beneficial to both parties. So we could do a $30,000 owner carry, and we could do it for 5 years at 5% interest. And that means that buyer is going to pay you $566 for the next 5 years. So you're out of your house, you're on to the next thing, whatever that looks like for you and your family, but you're going to be getting $566 a month for the next 5 years. Not only are you going to get the $30,000, you're going to get almost $4,000 in interest as well. So you're going to make the extra and you're going to get some interest. So you're going to sell your house for $500,000, do the regular $20,000 down. And then you get to do this amazing thing where you get a little extra cash for the next 5 years. Now you think, well, that the buyer has to pay that. You're right. The buyer is saving $900 a month on their loan when they take over your mortgage rate or your interest rate. So for 5 years, if they have to pay $566, which is 2/3 of what they're saving. So they're still saving $300+ a month. They're still saving that money. And then in this 5 years, when this is up, they're now saving the $900. So to them as a buyer, they're like, I'm still winning. I'm still coming out way ahead. And now this is a way for you as a seller to make some extra cash, right? So I want to stop this share right now. And I want to get back to this. So there's lots of ways we could arrange this, but for some people, it's actually going to be that you're upside down in your property. Very, very few, but there are going to be some where people are like, listen, we're struggling. We can't make it. We can't make the payments. We got to move, whatever it is. We're going to be able to say to that buyer, here's the deal. It's only worth $450 right now, but we're going to sell it to you at $500,000, which is above what it appraises for. But that's a great thing. No appraisal needed in an FHA assumable, right? But you guys are paying a little extra, but your payments are still going to be considerably less. So now they're getting the savings. They're bailing you out as a seller because you're upside down. And we do something, creative to get them to pay the commission. So you're saving a couple of bucks there also. So there's lots of scenarios. We would love to help you out. Like I said, I'm Gary Meek with the Living in Sacramento team. Not every agent knows this. Lenders don't quite fully understand this. If you want some more information on this, go ahead and message us in YouTube. Click on one of our links below. You can email us, text us, and ask more questions. Let's talk about your specific loan, your specific scenario, see how we can help you. And then the last thing is this. If you're thinking, I'm in a place where I'm actually in a good spot, I like my house and I like my interest rate, but I was thinking about selling and I don't want to sell because I'm not going to get this great interest rate again. I want to move up to a $700,000 house. Well, what if we could do the same thing for you? What if we could help you sell your house as it is today to that other buyer that's going to get your interest rate? But then what if we could help you get into another house that somebody else is selling that has one of those great rates? So you get to sell your house, get exactly what you want for it, and then you get to upgrade and get yourself a lower interest rate on the new house. The whole reason you did not upgrade was because of the 7% interest rates. What if I can get you that $700,000 house, whatever that number is for you, and I can get you that low interest rate? We can help. Message us, reach out to us, let us see what we can do. Hope you guys have a great day. Talk to you soon.